Welcome back, everybody, to the DeFi panel. We have a very esteemed group of panelists here. We have Ben Tsai, Jason Reed,
Clark Reed.
Clark Reed, and Jason Huan. I'll let them introduce themselves briefly.
Yeah, sure. I'll kick off. My name is Benjamin Tsai. I'm a co-founder and president of Wave Financial. We're an SEC registered investment advisor here in LA. We focus on crypto. I also teach the crypto finance course at the Anderson School for the Master of Financial Engineering program. So, handing it over.
Hello, I'm Clark Reed. I was a currency trader on Wall Street in New York and Singapore for a long time, and then I joined a crypto company called Shapeshift in 2017. It's a retail Unchained market maker and investment firm. And then for the past 2 years, I've been at Gemini, which is a crypto platform started by the Winklevoss twins.
Hey guys, I'm Jason. I'm one of the co-founders of Frax Finance. We're the fifth largest stablecoin in circulation right now, ranked about 30th in terms of total market cap cryptos, around $1 billion in total FDV. Other than that, I'm also a co-founder of Blockchain at UCLA, which is the largest blockchain club here on campus between both the undergrad and graduate programs. We do lots of cool stuff, mostly hands-on, theoretical applications, etc. I also teach an undergrad course here within the engineering school, distributed algorithms and blockchains, which has been going on for about 4 years now. And then other than that, I was also a undergrad engineering graduate from the computer science department here in 2021.
Great. And just to start off the panel, as we did the other ones, I'd love if each of you could give your own opinion on the difference between DeFi and centralized finance and how you see it revolutionizing the world currently.
I'll pass it on to the most experienced DeFi person there, and I can cover on the back end here.
Yeah, so just to clarify, kind of the contrasting between CeFi and DeFi?
Yes.
Yeah, I think obviously we're still relatively inexperienced when it comes to centralized finance. Ben has the most experience by far of all of us with that. But I can give some perspective on DeFi, which is that I think it's a very sort of builder-oriented space. I think one of the reasons why people are actually attracted to DeFi is actually it has very low barriers to entry. It really just comes down to a skill thing, right? So if you have sort of the skills to navigate the ecosystem, understand things at a threshold level, and also sort of interact with things and, make a map of meaning, you're able to actually get to all the places you need to go without dealing with any sort of licensing programs or anything of that's normally a gatekeeper. So really, DeFi sort of flattens the landscape when it comes to accessing financial services such as lending or options, whereas before those sort of more complex services might have been sort of gate kept by a broker and exchange. Here it's mostly just about sort of free flow information and also just knowing how to apply that information.
Mm-hmm. Now, a question for you, Clark. You're on the forefront of seeing institutional demand for crypto. How have you noticed that change since your time at Lehman Brothers all the way back in the day to now being at Gemini Institutional? What do institutions want out of it?
It's a good question. I think institutions are certainly curious about the crypto space. And kind of to your point before, Lane, they kind of feel like they have to get involved, right? Because otherwise they're going to miss it. So we've seen baby steps with big traditional financial institutions getting involved, perhaps from like one layer abstracted from actually owning the tokens themselves or custodying the tokens themselves. So they'll partner with a company like us to provide that service for their users in like a white labelable partnership. Or they'll invest in funds, or even have like JP Morgan has a big venture arm, for example, that invests in blockchain and crypto companies. So they're kind of currently taking baby steps to sniff it out and see where their fit is so that they don't get left behind. I think that's kind of where we are in the life cycle.
Very interesting. And Ben, you are an institution. So what made you make the transition from CeFi into crypto?
Yeah, I think in CeFi, it's a very established organization, and I think everybody, all the layers of the business have already been established. So there wasn't a lot of innovation going on. Everything is really fit and working, and to a certain extent, working okay. Bringing, crypto and blockchain technology into this is really changing and reshuffling that deck. The whole discussion about CeFi versus DeFi is really about reshuffling it so that the lenders and borrowers or the counterparties are able to much closer face each other with just a software layer in the middle, as opposed to having another counterparty. And I find that very exciting. And for what it's worth, that really is an interesting discussion in the sense that it's a new development in the finance world where it's much more evolutionary rather than some of the incremental changes that we're seeing.
Mm. Yeah, you have several funds inside of Wave Financial. So I'm curious, which ones are you seeing the most demand for? Which ones are you seeing performing the best? And if you could speak on that a little.
Sure. We run a number of different funds and they cover a very wide range. And what we're trying to do is really just build a foundation across asset management. We have index, we have venture, we have a crypto fund that's one of the first that takes advantage of crypto derivatives, which is a yield and upside product. Mm-hmm. And overall, what we're trying to do is we're trying to cover a very wide base. And, we gathered actually last night and talked about a few other things. We also have an NFT fund that does collectibles and VC in this space. We have a whiskey fund that, people keep wanting to talk about, is really for asset tokenization. And I'm trying to not talk about it because that ends up taking up the whole time. So.
Yeah, very interesting. Now, you're sort of taking this traditional route, right? Registered investment advisor and stacking it on top of this community that's so decentralized. So I'd love to hear about, Jason, what you think this meshing of two worlds might end up coming to.
Yeah. So I think from my perspective, I had a few friends who went into banking, like through my classmates, and it's a very sort of, well-stamped path. There's sort of like targets and benchmarks to hit. You kind of have a good idea of like, what sort of bank you'll place into or how well your career trajectory looks, just, depending on like a few years between undergrad and right after graduation. So I think that, in terms of what the ecosystem might look like, a lot of people in DeFi are quite sort of younger, and they also either have CFI experience, working within this traditional financial space, or they're just, fresh out of college. So within college, some people haven't even graduated high school. So it's a very mixed space, right? And the one thing you kind of see as a common theme amongst the sort of younger crowd or sort of the crowd there is that everyone kind of shares a collective understanding of the internet. I think that's one of the biggest things that differentiates the newer crowd, simply because a lot of these sort of the lingo you use on the internet or sort of the places where people gather and share information, mainly Twitter. There's sort of you need a shared culture in order to actually move things forward in terms of dialogue. But once you kind of hit that critical threshold, the space kind of just opens up, and you have a lot of people who have engineering backgrounds who are just building things in the space. Some people who are just have more free time, so they're able to learn how to build the tools. But yeah, I think sort of the mesh is that you actually get to see more pathways from the internet to go into a space like this.
Yeah. Now, a follow-up, Jason, you were saying a lot of your friends were going into banking, traditional finance roles, especially coming out of UCLA. That's why you come to an institution like this. I want to hear what led you to creating Frax Finance and co-founding it. It's a stable coin around $1 billion market cap right now. So I'm curious how that process went from you abandoning the traditional route and trying to start something like this.
Yeah, I think abandoning is a harsh word. I think obviously someday I also want to have house kids, so the bells and whistles. But I think when it kind of compares to a traditional route, such as working at a big company and getting sort of the requisite experiences and so forth, building something on your own, I think it all just comes down to interest, right? And so it's actually it's just plain curiosity, I think, is the best way to describe it. It's something that, you go to bed at night, right, thinking about it, and you wake up and it's the first thing you think about, not as sort of just a means or as a, way to a goal, but because you just genuinely want to know more about how the thing works, right? And so for me, that's obviously what crypto was. When I first got into cryptocurrency, back when I was starting my CS degree in 2017, there was lots of parallels between, how the crypto space was developing, but also how my education was going with, learning about concepts like theoretical and also application level. And so, yeah, I think the main thing is like, a lot of people, especially coming to institutions like these, are presented with opportunities and also show like examples of people going into institutional roles. And I think that, maybe the reason why I wasn't, or I didn't end up going down that path is that I basically got so drawn into cryptocurrency, I didn't have time for anything else. Mm-hmm. So, kind of happy accident, if I were to put it like that.
Yeah. Just the last question on career. There's been a lot of talk on that. I want to hear your transition, Clark, from traditional finance into moving into this crypto space, and any advice you would have for people as well.
Sure. So for me, as a currency trader for a long time, I saw as crypto started to grow and rise throughout 2015 to 2017 and thought, oh, this rhymes so much with what I know, but it's so different. It was just really intriguing to me. And so In the interest of getting a little bit more transferability in my own career, right? Because working on Wall Street, you do one thing and it's one very niche siloed thing and you're one of 20 people on the planet that do it. And you do it better than anybody else, but it's just that one thing. I wanted to kind of blow that up and get some more transferable skills. And I think, moving to a different industry like crypto and starting over, but not starting over at the bottom of the totem pole, because I could come to the table with some unique skills and value to bring to an organization. Was kind of how I navigated that transition. It took a while, certainly. It took like a year to kind of educate myself about the space and network in the space to find the right opportunity, all that kind of stuff. But it's worked out pretty well. I've enjoyed it. I feel like I'm a much more dynamic professional overall from having worked in crypto, just because it touches so many different parts of industry and politics and math and cryptography and everything.
Right, as we saw today on all the panels. Yeah, just a follow-up question. What's the difference you see in asset forecasting in between the currencies you were trading and now looking at crypto markets?
There's some similarities in the sense that unlike an equity, for example, where you can just model it out based on cash flows, and it's pretty straightforward, or any other type of security, really, in traditional markets. With currency trading, it's all pretty relative, right? We would have economists at Lehman and Barclays and Credit Suisse. They would say fair value and purchasing power parity for the euro is like 175 or something. But in reality, it's trading at 110, right? And so clearly, those vast divergences between fair value and real market price are evidence in crypto all over the place, right? And so I think there's similarity there, but obviously just because of the unique nature of, really, it's just a technology layer, it's a settlement layer, and you can kind of use the composable pieces to form it into whatever structure you want when crypto is concerned. And so as a result, you end up with two tokens. One might represent whiskey, and one might represent, the governance token of an, automated market maker or something, completely apples and oranges. So, a lot of complexity.
Yeah, same question to you, Ben. Where are you really seeing value in forecast or event driven inside of the cryptocurrency market?
Kind of taking a step back, I look at cryptocurrency as another asset class that's to be added into finance. And, decades from now, there'll just be another asset class. It's not the new asset class. Maybe we'll be working on something else at that point. But so I've had the fortune of working through equity and then fixed income, and then I ran commodities. So I really see, new and different asset classes being added into finance over the span of decades. And the last one that was added was really commodities. A few decades ago, commodities was a very niche thing. If you want something done, you call a little bank in Texas. And then Goldman Sachs went and bought Entergy Coke. Went and bought J. Aaron. Merrill Lynch bought Entergy Coke, and JP Morgan built their own desk. All of a sudden, commodities was a Wall Street thing, and it was an extremely profitable thing because clients needed it and the banks provided it. So we're starting to get close to that. We're starting to see the banks saying, oh, well, if clients want crypto, we can do crypto. So we're kind of on the precipice of that. And what I can see is, I think commodities, when it was set down, they decided to put it in fixed income. And I can see the crypto desk being somewhere between commodities and FX. And there's some parallels also with regards to commodities, in the sense that commodity ETFs were launched more for retail after the Wall Street people stepped in. At first, it was future-based, and later on, it was spot-based. And right now, what we're seeing in the U.S. is we have Bitcoin ETFs that are future-based. And at some point, we think SEC will come around and say yes to spot-based ones. So it's really history repeating itself. They're just taking their dear time.
Yeah, you seem very excited about your new fund that uses derivatives on these crypto products. Where do you see that moving forward?
So the derivatives market in the traditional asset space is, I would say, at least 10x, if not greater than the spot base. So there are a lot of people doing contracts between each other, among themselves, on the underlying, and that's a very exciting field. In crypto right now, the derivatives space is probably smaller than the actual spot space. So I think there's a lot more potential growth there. I wouldn't necessarily say it's 10x, but there's a lot more growth there. So we're really excited to see that. Yeah. We launched our crypto derivatives fund actually about 3 years ago. And 3 years ago, it was very new. It was the first fund in the space that was taking advantage of this. Mm-hmm. We've seen the market grow significantly since, and we're now even seeing derivatives and DeFi, derivatives showing up on DeFi platforms. So that's a very interesting new combination also. So overall, it's a very exciting space for us, and we're happy to do more there.
Ben, I have a question for you. How do you guys think about credit and counterparty risk when it comes to crypto derivatives? Because that's kind of one of the biggest gorillas in the room, at least that we think about from a risk perspective.
Sure. So there are many different ways to kind of slice this, and there are, kind of good and bad ways. And we talked about this a little bit yesterday. 3 years ago, when we started our fund, we traded on Deribit. So we trade Bitcoin options on Deribit, and we would have to deliver collateral to Deribit. It would sit on Deribit. And we're not excited about the idea. Deribit is not officially a custodian. They're not really regulated anywhere. So we really wanted to improve that situation. And about 2 years ago, Copper came up with this third-party custody solution and called Clearloop. So we now use them. The collateral sits with Copper instead of being delivered to the exchange. So it's almost like an escrow service, a third party there. So from our perspective, we're really trying to improve on the risk there. And I think the next iteration that we're going to see is really about having collateral sit with a smart contract. And so nobody holds it. It's actually locked up in a smart contract. And when the transaction's complete, the smart contract knows to who to deliver the collateral to. And conceptually very simple, but you have to make sure that the smart contract is able to deliver properly. It doesn't lock itself up. It needs to know that it's making the right determination at the end, that it needs to account for all cases and so forth.
Yeah, I would like Jason to speak on that too. I saw Frax is on Aave, one of the largest lending protocols. Has there been any issues with security, smart contracts when integrating with these lending protocols? Do you have any fears about what could happen integrating with these decentralized lending protocols?
Yeah, I think and just for some context, Aave is one of the two largest lending protocols on Ethereum. It's by far sort of winner-take-all market, where the largest ones essentially have all the liquidity for people looking to do crypto lending. So for example, you can lend your ETH to Aave, borrow USDC as a stablecoin, and effectively take a short position, long position on ETH, leverage up, etc. But when it comes to integrating with some of these like larger projects, I think systematic risk is always there, but the kind of ghost in the shell is that you actually don't know what it looks like, right? Because you can look at the code and it's very transparent and actually gives you another degree of freedom into what might go wrong if things were to go wrong. So you actually have more of a sense of what to look for, right? It's not just like, oh, hey, like they weren't returning our messages. It's more just like, oh, wait, we can see total, collateral in the system versus, the outstanding positions, sort of the risk there. I think it's more so just one sort of design risk, right? Like, is this sort of the right platform or project to sort of keep, continuing with, right? Like, how aligned are you guys in terms of like overall vision, growth, et cetera? There's also, like other lending providers trying to do different things. And then second is just the system, the kind of platform risk itself, or the smart contract risk, right? Which is like, does the thing actually work properly? Can it get hacked? I think in the latter case, it's an obvious just, auditing firms, they audit lots of these things. And so the big ones, obviously battle tested, having, billions of dollars locked in them. But for the former of alignment, I think that's something that's more fluid. Obviously one thing that kind of is always to watch out for as the space develops.
Yeah, interesting. Clark, do you notice institutions having any appetite for decentralized lending, or is there appetite for derivatives, or do they not care? They just want you to take care of it and they want exposure.
There's certainly some appetite, as evidenced by the crazy yields that we've seen in the past couple of years. Things have moderated a bit now after some of the credit issues that have, manifested themselves in the ecosystem. There's interest, but there are a number of different hurdles, I think, that institutions have to consider before going in. A big one is KYC AML, right? If you have tokens just sloshing around in a protocol and you're putting some in and getting different ones out, and you don't know where they're coming from, it's tricky for traditional investors to wrap their heads around that. Like the legal and jurisdictional aspects of things are also a complicating factor when you think about it, for a whole variety of reasons. But really, code is law works for the DeFi degens, but I don't know if it works for like, the New York Fed or whatever, Bank of New York or whatever. So yeah, like we have a variety of different ways to structure things so that we can kind of sit in the middle and bear some more of that direct risk in the same way that Ben, I imagine, does too for some of his funds. Yeah. So we can structure it to look like a traditional investment vehicle that's palatable to the traditional investment community. Yeah. And then we bear, in exchange for some kind of cost, ironically, because crypto is about getting rid of middlemen, right? But we sit as the gateway in the middle to help bear, make things more palatable.
Yeah. Yeah. And you brought up the high APYs coming off of these coins from staking. I'd like to ask Ben, do you think there's sustainable business models inside the tokenomics where they can offer, holders of these currencies 10, 15, 20% APYs?
I think it depends on the ecosystem. It depends on the platforms that we're talking about. And fundamentally, this is something I look at a lot with the rest of our team. We actually run a DeFi fund also and a number of especially accounts for clients just to focus on DeFi. And, one of the big analysis we do is where that source of revenue is coming from. I think the easiest one to understand is if they're sharing their kind of exchange fees and other revenues that they're collecting. So you get a cut of that. And that's something we're super comfortable about, right? The platform makes money from different people doing transactions on it, and you get a cut of that being let's call it almost an owner of the platform. I know it's not ownership because it's not equity, but kind of a revenue sharing model. And then that makes sense for us. The one where we're a little less excited about is really them providing their own platform tokens as an incentive to get people to trade there. I get it. It makes sense. It's pre-selling services. It's like prepaid tokens. So there is a justification for it, but the revenue model is a lot less robust because it's assuming that platform will continue to operate. So those are things that we look at. Obviously, the quality of the platform and the quality of the client base dictates a lot of what we think about the revenue that comes out of it.
Yeah, there needs to be utility backing.
That's right.
Why. What sort of investments have you guys done inside your DeFi fund, if you can disclose that?
Sure. I mean, we do a lot of DeFi work. We have actually a fund that we launched early last year, for $100 million that's going around really supporting the new DeFi platforms that are coming out. Fundamentally speaking, if a new platform spins up and there's no base of capital, there's no base of liquidity, nobody would go trade there. That's kind of a little bit of an Achilles heel of DeFi, right? In traditional finance, if one of the two counterparties is big, has a big reserve of cash, they can serve as, let's call it the bank or the house, in that parlance. But when you have DeFi, where you're talking about two anonymous people coming together to do a transaction, there is no pool that they can trade against. And that's where the platforms are kind of the weakest at the moment of their creation. So what we're trying to do is we're trying to provide that first liquidity layer to support the growth of that. And we think it's good for the ecosystem. We think that it's profitable for the trader, for the investors that come along with us that take advantage of that. And I think it's a great thing for, making sure that some of these new projects that we like to succeed.
Largely providing liquidity.
That's right, providing additional layer of liquidity.
Yeah, to pivot a little bit, Jason, if you could educate everybody a little bit on stable coins and your concerns about, the future of stable coins, maybe what happened with algorithmic stable coins over the last year.
Yeah, sure. So I think as a category, stable coins have been sort of either overlooked or, maybe not given enough attention to, at least before sort of the recent bull market. Obviously, stablecoins provide a lot of use case or utility for blockchains themselves, right? Like you're actually able to have a stable purchasing power asset being held natively on a digital, blockchain, right? And so for the first time, you don't actually have to rely on banks, holding your money for you. Of course, there's different trust models. But at the end of it, right, like now instead of dealing with a bank account, you're dealing with sort of a piece of code with its own sort of trust assumptions, right, depending on how the things are sort of constructed. So I think stablecoins itself were a huge space for opportunity, at least pre-2020, 2021, being so useful but not being so well created, right? And so in the sort of parlance of algorithmic stablecoins, there was actually attempts, dating back to 2018, or even actually theory dating back to 2014 of like how to actually create a sort of, Bitcoin dollar, right? Or like, how to actually create a unit of a purchasing power that's stable, but on a blockchain, right? So there's been different sort of stability mechanisms that have been theorized. And so it really took until 2019 for the right pieces to get into place for the sort of explosion of stablecoin designs that you saw within the 2020 market. And the reason for that is primarily just because you needed two things. You really need one thing, right? But the two things that came up in 2020 were decentralized lending and decentralized exchanging, right? So decentralized lending obviously allows people to leverage up without the need to, KYC or, go through any sort of a siloed process. Obviously allows, assets to be used between different protocols instead of being stuck on an exchange, only being able to be used on one exchange. But the second thing, which was a bit more important, was actually the advent of decentralized exchanges, right? So the reason why this was extremely important was because, pre sort of 2019, 2020 days, in order to get any liquidity at all for a token, you would need to go visit a market maker, right? or at least one that was working with an exchange to get your token listed onto the exchange. And so the obvious issue with that is that not every token can be listed on an exchange. The exchanges themselves have their own sort of operating models, constraints, etc. And so the ability to, have Uniswap come along, deploy a set of contracts such that you can actually create liquidity for any two tokens, allows the sort of starting threshold for any project to go from, a certain nebulous level down to just a set of steps you could take to provide something instantly. So it really was sort of a shift fundamentally in the landscape of cryptocurrency when the sort of advent of decentralized finance finally got into place.
Yeah. And we see that decentralized finance has a place, right? A centralized exchange, FTX, collapsed and kind of caused a lot of issues. I'm curious, do you see this wave of people, having fears of centralized exchanges and moving off a lot of liquidity? Do you think that's here to stay?
Yeah, I think in terms of course, FTX is sort of rung strongly in everyone's minds, etc. But I think that kind of idea boils down to, there's sort of risk everywhere, right? You can't actually you can't get away from risk, right? Risk will always exist, whether it's systematic, whether it's sort of, packaged into a single product, whether it's sort of, you can move it around, but sometimes when you think you've moved it off the map, it's just somewhere where you're not looking, right? So, I don't believe that decentralization fixes everything. I think that there's also some inherent assumptions you need to make for any system that's complex and has moving parts and works together in order for the thing to be possible. But I think that decentralized finance offers you the ability to sort of create new layers of transparency and also computability when it comes to these sort of things, right? So the main example here being smart contracts holding the funds versus centralized entities holding the funds. At least in the smart contract case, you can actually see sort of the trace of where everything came from, et cetera. You might not know exactly what might be happening with it, but at least you have an idea of sort of what might be going on. So I think it's sort of one more degree into the open information sort of dynamic.
Yeah. Clark, I would love your opinion on this too, coming from a centralized exchange.
Yeah, I think the real world is messy and hybrid, right? It's not like a binary thing between centralized and decentralized, and it's not necessarily decentralization in and of itself is a virtue, full stop, right? There are trade-offs like any other thing, anything else really. I think that what's powerful about this, about DeFi overall, is the fact that you're taking what used to be analog and turning it digital, right? But it's not just that, because you have Venmo and that doesn't have a blockchain behind it, right? It's also taking closed source opaque systems and legacy infrastructure like banks and turning it into transparent open source toolkit. And it's composable pieces that you can stitch together. So whether you're talking about the NFT guys and their digital provenance stuff for any type of asset, whether you're talking about the ability of a protocol or a project rather to bootstrap themselves into existence using an AMM like Uniswap, all these tools can be stitched together in a variety of different ways to accomplish various goals, I'd say.
Yeah. Ben, I remember a couple of weeks ago, you told me the next wave would be a new wave of decentralized exchanges. What do you think it's going to take for there to be mass adoption to, get my grandma off of Coinbase and get them onto one of these dexes?
I think it takes still a bit of time. And I think there's a lot of value in centralized exchanges. I'm not saying it because we have someone from Gemini here, but, from my perspective, I think the next iteration of exchanges, which we talked about last night, is a non-custodial centralized exchange. I think one of the really odd concept, if you really think about it, is that exchanges right now that are centralized are not officially custodians. They take on people's assets and then they do something with it in terms of trading, and then they return client assets. You think that they are serving as a function as a custodian. I travel around globally and look at various businesses. In Japan, centralized exchanges are actually licensed also as custodians, which actually kind of makes a lot of sense if you think about it. So, from my perspective, going one extreme is to make all centralized exchanges custodians, so they're responsible for the holding of assets and so forth. And the other extreme is to have kind of the escrow type of arrangement that I talk about. And that is actually similar to a certain extent to traditional finance. When you are trading with the New York Stock Exchange, that stock certificate doesn't actually go from your house all the way to the New York Stock Exchange and come back. Everything is also virtually represented, and therefore that can be done with a lot of these centralized exchanges, so they become non-custodial, similar to my example from before. So I think that that's probably going to be the next path going forward, where centralized exchanges, you won't need to deliver collateral there, but you still interact with them.
I think the technology is going to help facilitate a lot of what you're talking about. You know, even the term custody, what does it really mean? It's holding something on behalf of someone else in exchange for a fee safely, whatever it is, right? But what happens if it's like the technology enables the four of us to each have a shard of that thing, right? And three of the four of us have to vote yes in order to move anything from the address to somewhere else. Who really has custody of the asset in that relationship, like from a U.S. legal perspective even, right? A lot of, traditional financial institutions and us, for example, we're trying to work through some of those things and leverage that technology to provide like safer, scalable ways to manage assets.
Yeah, custody versus non-custody changes everything from a regulatory standpoint. There's been a lot of regulatory attacks all over crypto, but I'm curious, have you ever been reached out by regulation, Jason? And, have you spoken with them? Have they expressed any concerns over stable coins? Any inside scoop?
Nothing sort of that's not already sort of standard for the DeFi space. Obviously, regulatory bodies move quite slowly. It's nothing that we haven't, aren't quite familiar with. So, it's pretty par for the course.
Yeah. Are you worried about regulation coming in, maybe banning stable coins?
I think regulations themselves also move quite slowly. So it's, obviously it's sort of turtle race, but, at the end of the day, right, like, stablecoins are an iteration of the technology that's used to sort of, bring, blockchain to the application level. There's really actually no sort of, inherent reason why stablecoins can't coexist with proposed future regulatory, frameworks. I think it's sort of like a thing that actually needs to be sort of talked about and agreed upon rather than just stamped out. I think progressively, most at least lawmakers understand that some parts of this technology has merit, and there's quite a bit of information and utility in having a working sort of framework for it.
Do you have any opinions on a central bank digital currency?
I think that, CBDCs have been talked about a lot. They're obviously an easy talking point because you can just take the two ideas of like, hey, dollars, central bank fiat money, and then like, hey, like blockchain, like digital money, right? And you can just make a salad. I think that the core, conflation here with CBDCs is that you're taking a technology that was designed for a trustless or a trust minimized decentralized network, and you're trying to apply it into an area which is normally run by governments, right? This is sort of an inherent contradiction, right? You have sovereign monetary policy, which is one of the biggest goals for a government to be working properly, right? They have their own agendas, they have their own targets, they have sort of understanding of the details that makes things from their perspective run smoothly. And so, in sort of like the Bitcoin case or just, blockchains in general, you have a system that's just there to make sure there's no sort of fraud in the currency system. And so if you kind of stretch the two too much, you start to get, I would say, strange, logical claims when it comes to sort of implementing such ideas and so forth.
Yeah, I want to open it up to questions to hear stuff. But real quick, I just want sort of a hot take on from each of you what you think the future of DeFi will be, what Anderson students should be looking for over the next couple of years to come.
I'll kick off. Yeah. So I think DeFi is still early, so it's even hard for me to predict exactly what that end scenario is going to be. And I think that in itself provides a great opportunity for everyone to go look at and potentially develop. Right now, people are trying a lot of different ideas. Some are good, some are bad, and it's okay. It's like the startup space. Some will not survive. And the ones that do survive, they could potentially be extremely good. So I think it's really keeping an open mind, coming up with creative solutions to try to solve some of the existing problems in finance. And I think it's a great area of opportunity, and it's still very, very early.
Yeah, I think not just DeFi, but crypto overall suffers from a huge user experience problem. It's really, really difficult to use. unless you're a geek like us or whatever. So I think that abstracting away some of the crypto from behind it, like the last panel said, is probably a key step. Like people using DeFi without really realizing that they're using DeFi is yeah.
Yeah, I mean, I don't think crypto will vanish. Obviously, it's been made, ever more sort of present by this last cycle, but sort of whereas the space would go, that's always a tough question, right? Like no one really knows. I think kind of it just comes down to what sort of hits in the right order, and then what kind of how the market essentially follows that order of implementation. So I think it's just something to be like on the lookout for, and just be able to respond. Okay.
Yeah. Any questions for our panelists?
Yeah. So I want to talk about smart contracts as a you're fine. As smart contracts as a tool to create a very sophisticated investment product. Because when I was at JP Morgan, effectively what investment bankers do is invent products, and we know how well that ended. Then for 10 years, investment bankers got innovative, and then the systematic risks grow up and then explode. With DeFi, every developer is an investment banker who can deploy a new product for $3 for the whole the whole world to use instantly. So inevitably, that complexity at some point will grow to a point, and there will be systematic shakedowns. What is the industry going to do? Like when managing funds or creating stable coins, how a community is going to look, where to look for those systematic risks or overheated pools in areas to maybe reduce that before it happens. But what is the industry going to do in general when everyone's an investment banker?
I think you're bringing up a really good point, and that's where we at Way Financial are trying to cover. When I started in this industry, one of the concerns I had was a lot of engineers trying to do finance. And I think the easy thing is, I'll just invent everything from scratch. We'll start over. All of the previous history, we just ignore that. We'll be clean and fresh. And I think the reality is that there's a lot of lessons from the mistakes that have been made for the past few centuries in terms of commerce and finance and so forth, that there is some value there, that I'm not necessarily sure we should throw the baby out with the bathwater type of concept. And not every programmer is going to be a good banker, and most programmers have not gone through a lot of the regulatory concerns, a lot of fundamental financial training and so forth. So there needs to be a balance there. With that said, I think the good thing about having programmers or having people who are not from the industry is that it does come up. You come up with new different things. When I joined banking to be a structured products person, I came from an engineering background, and that was actually a positive because I got my financial tools from Anderson and I had my engineering background, and that was a good combination for me to be creative with what tools are available in finance. And I think that went pretty well. So.
Anyone else want to jump on?
Yeah, I'll add on to that. I think you make a good point about sort of, how do you look at the risk, right? Because given, the components individually work does not guarantee that there's no systematic risk, right? So it's always a good question. And in some sense, you can't actually predict them, the big ones like the black swan shocks, because they haven't been seen before, right? So it would almost be too neurotic to try to sit there every day and think about the way the world could end. But I think you have a good point, which is, I think you have a good point, and I think the way to kind of prepare for, systematic risk is just to have worst case scenario, like, sort of fallback plans for everything, if things might go wrong, right? Obviously diligence is the sort of the prevention here, and obviously a much cheaper, kind of cure for this, being that, if you kind of build these things, with a conservative mindset of, not maybe optimizing for short-term growth, but for long-term sort of, potential, you get a better, robust system that can actually support the demand that might come onto it, rather than just optimizing for single metrics such as token price, et cetera. So, yeah.
Yeah. You have a question?
Yeah. You mentioned one thing that got me thinking about something that, Jason is tangentially related, which is that, a lot of liquidity providers are chasing yield, like which platform can give you the best yield, right? Deposit certain stable coins and take advantage of transactions. And there are vampire attacks that will happen where, another like Sushi Swap, the Uniswap, where they'll basically create a similar, platform and then incentivize liquidity providers to transition whereas they will get higher yield. And so, Jason, how do you think about kind of mitigating the risk of vampire attacks? One, and then two, kind of learnings that you may have gotten from the Luna UST debacle where it was, of course, Frax has the minting and kind of, redeeming mechanism, which is, different than Luna, but what are some of the takeaways you got from that and how does that make you better going forward?
Yeah, I think the obvious, in terms of your latter question, I think the obvious case for Luna is just maybe sort of a case study in diligence. Maybe some of the things that were sort of growth factors might have been the things that kind of caused your risk or your kind of the collapse on the way down, right? So kind of understanding that all things have a double-edged sword in this case, right? There's growth, but then there's also sort of what happens on the sort of other side of the parabola. Essentially just diligence. And then, regarding your first question, I would say like some of these more, maybe, business-like, behaviors, right? When it comes to sort of like platforms in which you mentioned vampire tax. I think that's nothing, actually new. I think that's a very actual, that's just what we see in just, the history of corporations going back thousands of years or hundreds of years. So, yeah.
Okay, we're going to wrap it up there. Let's give a big thank you to our panelists.